Hello and welcome to Livewire's Fund in Focus. My name is Chris Conway. Today I'm sitting down with Michael O'Neill, who is a portfolio manager at IML. He's going to be talking to us about the Investors Mutual Equity Income Fund ETF, trading under the ticker code EQIN. Mike, it's great to see you again. Thanks for sitting down with Livewire.
Thanks for having me, Chris.
Of course. The new ETF, it leverages the strategy of the IML Equity Income Fund. But for anyone who's not familiar, can you just take us through the strategy, what's it designed to do and who's it designed for?
Yeah, well, we launched the strategy in 2011 and it was designed specifically for retirees or people approaching retirement. As you can imagine, right now, income sources that are low risk are hard to find. The traditional sources like cash or TDs aren't yielding quite enough. Equities would seem like a necessary evil to get that higher yield and a bit of participation with inflation. But if you're going to go into equities, you need to do so in a prudent way. So the fund really targets high income and low volatility, which are essential for retirees.
Yeah. Now the strategy, it's being launched in the new ETF format. The ticker code is EQIN, as mentioned earlier. Why offer it this way and what's the benefit of doing it as an ETF?
Well, I can tell you firsthand, when we were standing at the ASX on the 1st of September ringing the bell, my order was the first one.
Fantastic.
We've launched 4 ETFs now. So the beauty of launching it as an ETF is you get access to the mirror of the fund, effectively accessing the fund by buying a share on market. So you can imagine a lot less hassle than all the paperwork you'd have to do for a traditional managed fund. You can buy it on market. There's daily liquidity, intraday pricing. It just makes things a lot more simple and flexible.
Talk to me, Mike, about what is unique about the way that you invest, and then how does EQIN, how is it different from the other products that are available in the market, if you will?
Yeah, look, there's obviously a real demand for income and a lot of ETFs being listed with an income focus, but where we differ is there's not many that really focus on achieving that higher level of consistent income, but also doing so with lower volatility. That's what really makes us stand out, because we're not passive in our strategy. We're not systematically stripping dividends, which can result in higher turnover and higher volatility. We're playing that role of a lower risk, steadier income, all-weather sort of fund that retirees can rely on.
Yeah. You referenced it earlier, Mike, that equity income is hard to find at the moment. That's at the headline level, though. The story's a little bit more nuanced, of course. But generally speaking, why is it harder to find at the moment? And then where are you hunting for opportunities?
Yeah, so Chris, if you look at the ASX yield, it's been compressed towards 3.5%. The culprits, banks and resource stocks. So materials and financials together over 50% of the market. Yeah. There's also some sectors where you've got to be a bit careful, targeting income for income's sake, like the dividend traps, the companies with too much debt. The companies that have structurally declining earnings or unsustainable dividends, or they're more cyclical, such as your property trusts. So, we put those aside and we look bottom up to build a portfolio with lower risk stocks, a bit more diversity, in some cases growing yields, your healthcare stocks, utilities, staples. And we think it's just a better building block in terms of achieving higher income.
Yeah. Now, you've been doing this for a while, Mike. So do you think this is the new normal, or is this just a moment in time and, the market shifts and shifts back again?
Well, bank stocks have outpaced in their share prices their earnings and their dividends. Yeah. So unless we see some sort of correction, that's not going to change. Yeah. In fact, with lower rates, you could see dividends for some of the banks becoming under pressure in the next 3 years or so. And resources stocks are beholden to the iron ore price largely. So those two things, they are structural. Yeah. But the good news is outside of those sectors, there's plenty of stocks with growing profiles of yield whose share price has been left behind. And maybe those do more of the heavy lifting going forward.
Mike, let's give potential investors a bit of an idea about what makes it into the fund, the types of investments you make. So a couple of stocks that you like right now.
Yeah, so our portfolio is quite diverse. How about I give you one stock that we were buying yesterday to build. It's a new stock in our portfolio in the last year, and we were building a position yesterday. And then I'll give you another stock that we've held for a very long time. It's a higher conviction portfolio position we've held since 2013.
Sounds good.
So the first stock is Dalrymple Bay Infrastructure. They own the Dalrymple Bay coal terminal. They get inflation-linked pricing. The people that use the terminal have a socialised cost mechanism, so that de-risks them further. And they get paid regardless of the throughput through that terminal. So it's a very, very low risk stock with a growing profile of dividends, and it pays dividends quarterly, which is uncommon.
Yeah.
The second stock that we've held since IPO in 2013, Steadfast. Might not appear in a lot of other income investors' portfolios. It's grown earnings and dividends at a compound rate of 13.5% since its IPO, 2013. Why is that? Well, it's dominant in Australasian broking and underwriting. They get 95% retention in broking to their SME clients, so very stable business. And they grow organically and through acquisition. So think about what happened to the mortgage broking industry over the last 20 years, gaining share in distribution from the banks. The same is happening in insurance broking.
A couple of very interesting ideas there, Mike. None of those ideas come without a little bit of risk. So how do you manage the risks in the portfolio?
Yeah, so really for us, it's the bottom-up work and the active stock picking that manages the risk. We're looking for stocks with that steady growing profile of cash flows that are not dependent on the cycle to grow their earnings and dividends. They tend to be less risky, and if markets sell off, their valuations aren't overly exuberant like some of the stocks driving the themes in the market today, and their dividends give you an underpinning. So really what that's meant is when markets sell off, we tend to wear on average about 56% of the pain in terms of our drawdown experience, just by getting the stocks right, just by focusing on low volatility, long-term investing.
Yeah, great stuff. Talk to me about the targeted return and then perhaps some of the historical performance as well, just to give people a bit of a concept of what they're up for.
Yeah, so we explicitly targeting 2% above the ASX index yield after fees and pre-franking, and equally importantly, if not more so, at a lower volatility. That 2% above index yield comes from, on average through the cycle, 4% through dividends, a very diverse mix of stocks. 2% through options, that can fluctuate. It's really helpful to have that diversity of sources because if volatility spikes and dividends are less certain, options can do a bit more of the heavy lifting. You don't want to overdo it, of course, because we do like some capital growth in our portfolio. So we tend to get a little bit from capital gains, but not too much. And then historically, we've had 1 to 1.5% additional income from franking. On the volatility side, we've tended to be 2/3 of market. So it's not all about total return. It's about where you get that return. Getting it more from steady income means you're not having to sell down your units as a retiree when things get shaky or when dividends are tested. And lower volatility means you're not actually selling out at an inopportune time, impairing your capital balance and finding it hard to catch up. Our research shows that over the life of our fund, had you been invested since inception, those two elements as a retiree would have preserved your capital better than being in, say, a passive index option.
Yeah, incredibly important. It's not just about the return, it's about how it arrives, right? Yeah. Question without notice, Mike, I just wanted to ask, how many positions typically in the portfolio?
Typically between 30 and 40 stocks.
So good diverse mix, like you were saying.
Yes,
Yep.
So diverse across sectors, significant underweight to financials. We find opportunities in insurance companies and some of the, less cyclical parts of the finance sector. Some in resources, but again, that's quite a cyclical sector. So it's roughly 30 to 40 of your industrials, healthcare, staples, stocks.
Last one, where can investors find out a bit more?
Well, you can go to the ASX website, which I'm proud you can now, it's up there. And it's also obviously the great source is the IML website. So if you're investing in this fund, you are investing in the strategy that's been around since 2011, just through a different access point. So our PDS is up there, as is a lot of our historic marketing material and performance.
Mike, thanks so much for taking us through that. Congratulations on the launch of the ETF.
Thanks for having me.
If you enjoyed that Fund in Focus, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.